AI is going to replace all of this monotonous stuff that nobody wants to do and let people get back to learning about companies and learning how something operates.
Hello, everybody. Welcome to another episode of the Audit Podcast. I'm your host, Trent Russell, and today on the show, we have Brian Kuenzi. Formerly, Brian was the Director of SOX and Transformation at Match Group, and currently he's a founder at Stealth AI startup. But basically, Brian's an AI and tech enthusiast with that audit background. He's helping do some things with audit and accounting relative to AI, and so that's really why we wanted to have Brian on. And he is also just super interesting and has a maybe just hobbies and kind of background in general have made for Brian to be an interesting guest and one that we will certainly have back on. If you listen to the IA on AI podcast, Brian was a guest on there recently also, so check that out. And he emailed me this morning and said, hey, we should do this for the next AI episode. And I went, all right, yep, that's a good one. So we're going to talk about that. Probably this comes out on Tuesday, tomorrow, I think, if I have the timing right. I don't have a calendar in front of me. So just trusting my brain is never the best idea. But I think that those dates are going to work out like that. Some of the things we talk about is how, or rather why, audit struggles to get resources. And it's about a 20-minute, I guess, ish preamble about incentives and relative to the board and executives. So like how they're incentivized, incentives they get. And then Brian just like quickly drops the hammer and brings it all together. So it's just like really interesting story in an area that I was not super familiar with. And so I think it's all that to say, you might be listening for a little bit and be like, I have no idea, where's this going? And then there it is. So I thought it was super interesting and really enjoyed it. Brian also likes to say break hard to go fast, and what that means for internal audit. Basically, internal audit as an enabler as opposed to the police, which is a conversation we've had on the podcast before, but this is from Brian's perspective. And again, with that analogy, I think it makes it really concise and easy to kind of digest. And then, of course, with Brian on the show, we talk about the future of internal audit relative to what else? AI. With that said, here we go.
Sort of how we got connected was through a mutual friend, and my sort of introduction to the, I don't know what you call it, accounting social world was I did a podcast with John, Audit 15 Fun, talking about passive investing and how that connects to audit, SOX, risk, compliance, etc. And so I did my thing where I kind of, I'm going to do this interview, I'm going to do this podcast, I'm going to write all my notes. And that turned into this long Substack thing. And then, so I posted that, and then it just sort of grew from there. But where this was born and why I was on this podcast talking about passive and why this matters is, for the last, since I started in this industry 13 years ago now, started EY Assurance. How I got there is a whole different story, a whole different podcast. But I did not come from like an accounting, like that was not my thing. I was like finance first kid. I was the finance bro. I was like, oh, I'm going to do investment banking. And then the Plinko chips sort of ended up with me going to Ernst & Young in Dallas and doing audit. Okay. But I always had this different perspective on stuff, and I still do. And for the longest time, I had this sort of inkling of like something doesn't add up. Like nothing makes sense to me about why, you think about what audit was, external audit or any internal audit, and it's there's a definite value add there. There's you see the whole company, you're involved in all this stuff. But it seems like the way that people are, auditors are viewed, or, oh my God, here comes the auditors. That sort of perception was really strange to me. And I remember sitting at Celebrating Seniors at EY, which is like this big boondoggle that they have for like your third year. And they brought in they made the mistake of bringing in a PCAOB board member to like talk to like 300 of the newest seniors at EY and doing a Q&A. And at one point, if you can imagine sitting in this big conference room, ballroom, and they're doing a Q&A, and kid next to me like raises his hand. He goes, and this is, by the way, to give you a timeline, this is 2015 ballpark. So SOX was like 2002.
Mm-hmm.
Decade later, I started in 2013. So this is 12, 13 years later. And this is right around the time where everybody had sort of figured out what SOX was and how to, like, it was just ramping up. And we were under a lot of pressure to go to our clients and say, hey, we got to do all this control work. We got to do all this control testing. All the internal audit groups are now having to do all the SOX work. And so all the things that used to be, quote, value add are now being diverted to SOX.
Yeah.
And this board member basically the guy raises his hand and he goes, hey, when are you going to tell our clients that we're having to ask all these things and do all these things and ask for more money? Shouldn't that be y'all's responsibility? You're the ones that make all the rules. And the guy literally goes, we've spoken to investors and we know it's important and it's really not our problem. And the whole room is like, and my thought was like, who are these investors you're speaking of? Because when I look at the investor, as you do your stuff, you're like, okay, who are the top investors of your publicly traded companies?
Yeah.
And it's BlackRock, Vanguard, State Street. And I was like, that seems strange. And I just always thought it was weird. Fast forward roughly a decade, we have COVID, and COVID was strange. At this point, I'm now out of public accounting. I'm in, working for a big public company doing SOX stuff. COVID happens, and I come across a guy named Michael Green. And Michael Green is famous for basically running Peter Thiel's money. He's known for the short VIX trade. He's a money manager, but he has been on this research path of passive investing since like 2015, 16. And he opened my eyes to what was really going on under the surface and the power that these quote unquote passive things have. And so let me define passive. Passive, in the context of US equities and really global equities, but we'll just focus on the US for a moment. Passive would be the large ETF, your S&P 500 index funds, like that are owned by Vanguard, BlackRock, State Street. And passive basically runs on the world's simplest algorithm. If you give me cash, buy. If you ask for cash, sell. That's it. Vanguard does not care who the CEO of Apple is. They don't care who Tim Apple is. They don't care who, what the earnings of NVIDIA are. Okay. And these passive, these big three, there's really more to it, but these passive funds have essentially eaten up the market, not only in the US, but globally. We're really going to focus on the US because that's where everything kind of happens. And it's been growing for decades and decades. And what that has created is inelastic supply and demand curve within global markets. So I'm going to pause there for a moment to let everybody kind of catch up. Does that, what I'm saying, sort of make sense, or do I need to?
No, we're following. Keep going.
We're following. Okay. So when you look at, we'll just take the S&P 500, so the market, if you will, and you could do this for the total market. Vanguard has the largest ETF in the world is the Vanguard Total Market Fund, which is basically their way of buying all of the all the equities, which is, I don't know what it is, 4,000 equities in the U.S. But when you look at any single stock, literally the top holders will be Vanguard, State Street, BlackRock, Price, some other ones. And that share, used to be, I grew up thinking like, oh, like Gordon Gekko and Wall Street, and like there's these, quote unquote active hedge funds, etc. That composition has shifted over the last really 20 years. And so now on a daily basis, the global fund flow of active versus passive is, passive probably has roughly 65% of the daily flow, if not more. And what that has caused or created is inelastic price discovery, meaning Vanguard's going to buy Apple and Nvidia and Google and these large mega cap funds because they get inflows from your 401k contributions, etc. And they don't care what the price is. And so what I'm trying to say is that the incentive, if you're the CEO of insert publicly traded company, your incentives, your incentives have obviously are shareholder value, like shareholder supremacy. It's always about the shareholder. And if you just happen to be one of these large companies, nobody really cares what you do because you're going to get that flow. Everything runs on flow. And that became very apparent to me as I'm watching, COVID was a weird for everybody for a lot of different reasons, but you kind of go, wait, okay, so we just took a 20% haircut overnight and that gets into the derivatives market. But then this thing just Super Bowl bounces. Meanwhile, you're like, oh, a lot of these companies don't have like earnings growth. Like Apple hasn't grown in the traditional value investing framework for a long time, but yet it's one of the largest companies in the world. And so what Mike basically were brought to my attention and highlighted for me was because, when you work at a company, and by you, I mean like the mass majority of us, you work for a company, whether it's private, public, whatever, you contribute to a 401k. Your 401k, generally because of, and I made sure I have the correct, in 2006, the government changed the rules. They've done a lot of things that have changed the rules that have created this thing that, this passive monster. They changed the rules. It basically said, if you are a company and you have a 401k, which everybody does, and you have to they basically created a rule that said you need to have a qualified QDIA, qualified automatic investment. I forget the D part. They basically said you can't just have, when Trent is a new hire, you sign up for your 401k, we're going to automatically put you into something. It used to be that wasn't a requirement. People would just like sign up for a 401k, not do anything. It would just sit in cash.
Yeah.
Well, they said, on contraire, we're going to force you to have automatic investments for these people. And usually that's a target date fund. So you'll hear like Vanguard target date, and it's usually based upon your age. So everybody's basically forced into doing these things, knowingly or unknowingly. Like you have to opt out. And so what ends up happening is every 2 weeks you contribute to your 401k. Unless you opted out, you're in a target date fund, which is mostly just basically you aping into 95%, if not more, of your biannual or bi-weekly contributions to the S&P 500 or the QQQ or whatever that Vanguard has. And so once that kind of dawned on me, because I go, I harkened back to this PCOB board member, and I'm like, who are these investors you're talking to? And I go, oh, they're Vanguard. That's who it is. That's who they're talking to. Like there is no, I mean, there are, and we'll get to this in a second, there are still active managers. Matter of fact, Elliott Management, one of the largest quote unquote active managers in the world. I forget, I have his name here. One of their MDs I was listening to, I stumbled upon this because I usually stumble upon a lot of things, but I was watching an interview with him, and he was talking about how for them, this has made it very difficult for active investors to make changes, because like they think about, like, if you're going to go and have a proxy vote, and let's say 40% of the active float is owned by Vanguard, State Street, and BlackRock. Like, how are you, if you're an active manager, why even bother trying to change board seats? Because you can't get the votes like mathematically. So what do? You create a circus. Like Elliott basically created a circus for when they took over, did an active campaign against Southwest Airlines, which is partially why Southwest Airlines now has the different seating and the different prices or whatever. But they literally went out and made like a podcast, this big to do, but they can't get the votes. Like, and he even talks about it. It's so difficult for them now, and it's a big problem. Jesse Cohen, he's a managing director at Elliott, and like he's talking. I wrote about this in my "Can You Take Me Higher" post. There is no, because most of the publicly traded equities, and it's not just the S&P 500. It's like, you can do the Russell 2000. It's all of them. They don't have anybody, that there's no invest, like the shareholder doesn't care. Like the majority of the quote shareholders are, if you give me cash, I'm going to buy. If you need cash, I'm going to sell. And they don't really care about the earnings. They don't care about the corporate governance. They don't care about any of this stuff. And so if you're a CEO, this goes back to the incentives. This is where I'm going to get with the incentives. I'm pulling this full circle. If you're a CEO and your board comes to you and says, hey, our stock price is not performing well. You haven't done this, that, or the other thing. We need to generate growth. Because the stock price has always been the response, the scoreboard, if you will, for companies, right or wrong, whether you agree or not, right or wrong. And if you're a CEO and you're like, okay, well, not only because of stocks now, most of my equity, most of my compensation is tied to my stock price. Now I got the board up whatever, telling me I need to, do growth, etc. I'm not really interested in slowing down this train, right? I have this great saying that I'll use. It's brake hard to go fast. And I'll tell you what that means. But like, they're not thinking I need to really like put on the brakes, because I need to go as fast as I can, because I got to generate growth. I gotta get the stock price boost. I gotta go. And it just creates poor incentives on the one hand. And then on the other hand, because the flows are all that matters, you see these weird things. Like SMCI is a great example that I use a lot, where SMCI gets delisted. I want to say it was I think it was pre-COVID the first time. They get delisted. You can look it up. I'm not going to drag them through the mud. They get listed again on the NASDAQ. Like I think it was 2023, they did the same thing, literally the same thing they got delisted for. Stock drops 40%. Well, just give it a moment. I don't know if you recall, they were part of that AI bubble early on. I think they lost 40% or something. EY dropped them. Like literally the entire Big Four dropped them because they just can't get past like making up numbers. But the stock recovered, no big deal, because guess what? They're a part of the S&P 500 now. And so they get that flow, that constant flow, and nobody cares about what any of the corporate governance is. So
2 follow-up questions.
Yep.
One, this is the Audit podcast. I know we've talked about this, so I know you're going to bring it around. Relate this to the Audit audience. 2, if you watch the show Industry, does it make sense to you? Do you follow that show? Do you know what I'm talking about?
Industry.
Okay. It is investment bankers in London, and there's so much technical jargon. I have to watch everything with subtitles, but even that show especially.
Kit Harington's in it. Jon Snow's in it. I'm definitely going to add that to the watch list.
He doesn't start from the beginning, but I think he comes on season 2 or 3 or something like that. I don't know. We're not there yet. But anyway, you might enjoy it. It might be one of those things where you look at it and you go, this is like insanely ridiculous. The same way like when I see, I don't know, my mom was watching NCIS one time and they had this woman like hacking on a computer, and she was like, oh, I need more help, I can't get in. And so she like brought in another person to type with her on the keyboard, and I was like, this is the dumbest thing I think I've ever seen. So it might even be one of those where you're like, yeah, that's not even close. But anyway, it's hard to keep up with even the relationships on that show, like even with subtitles. I'm like, who is with who, and I don't remember. So anyway, that was just a goofy ass way to say
No,
that.
we're gonna add that to the me and my fiance, which is why I live in Durham, North Carolina now, not Dallas. We are big TV shows. We just finished Stranger Things. I was late to that party, and now um, we're actually watching The Sopranos. Like, I'm watching it again, but
Okay, I was gonna say
we'll
you're
have to
super
add
late.
that to the watch list. But
Super
you know,
late to that.
I sort of go in my who is Brian? Like, when I graduated, I was gonna do investment banking. That was my goal. I if you're 20 something years old, what do you, and you're a finance kid, well, of course you want to be an
Yeah,
investment
that's
banker.
it.
And, as the story goes, that I got to the 71st floor of the Wells Fargo building in Houston, Texas, and decided that was not the mountaintop that I wanted to climb. So, for in revisionist history, for poor reasons, we decided not to pursue that, but whatever. Um,
Okay, so TV shows aside,
TV shows
bring
aside.
this home, what we're talking about, to the
Yeah. Yeah.
audience relative to how it impacts audit.
Yeah. So, when I talk to
Or
people,
let me
it's
say
just
it a
all,
different way, even maybe even more blunt. Like, why should we care?
in summary, passive, um, has created inelastic financial markets, and it has shifted the incentives of the executives, both the board and the C-suite, because I think they have kind of caught on to what's going on. And so what ends up happening is if you're an internal audit at a big public company, and this could even apply to private companies, but at a big public company too, and you go in for your annual forecast discussion with finance, and you say, hey, I need to add a head. I need to add, 2 heads for internal audit or risk or whatever. And they go, okay, how are you going to grow the top line for us if we add, because that's a cost. That's not going to grow our earnings for the stock price for the shareholders. And you go, well, yeah, but I can add value in XYZ ways. And they go, well, do more with less. That line that you've heard forever, that I've heard forever, do more with less. A lot. So, like, where this kind of all came from was I had this discussion last week, another, like, verbatim, same discussion I always have. This has been going on for, like I said, like, over a decade, where my friends or my colleagues or whatever, they go, I don't understand why nobody seems to care. Like, you would think internal audit or external audit, or an auditor in general, is in the perfect position to add value to a company. They see the whole burrito. They're in, you're involved in all of the major discussions. Like, we buy an acquisition, we got to go do our due diligence. We got to figure out, when you buy, when you acquire a company, you have to integrate them and get all the processes, etc. And back to my brake card to go fast, to use an analogy of racing, the F1 drivers, they don't go all gas, no brakes like Coach Sark. They brake really hard to go really fast. Like, the best drivers in the world, the Lewis Hamiltons, the Verstappens, the ones that win are the ones that know how to brake well. And quick side note story, the brake hard go fast quote came from a professional driver. Like, I'm literally sitting doing one of these driving experiences, and he's like, you're not braking hard enough. And I go, what do you mean I'm not braking hard enough? And he's like, you got to brake hard to go fast. And what he meant by that was, as you're coming down a straightaway, you're coming to a sharp turn. It's not that you brake slowly into the turn to then accelerate out. It's that you gun it and go, and then you brake really hard. These supercars have really good brakes, so that you can then transition out and accelerate out of the turn. And that's a great line. But then I heard another asset manager talk about this in the volatility space. It's literally the same concept. It's risk management. If you want to go all gas no brakes in a race car or in a company or doing investments, you're eventually going to run off the track. And the way I view it, and the value add that audit has or should have, or I wish would have, is providing that assurance that the having good brakes, so that you can make those business decisions, those acquisitions, those, and have confidence that, okay, I'm going to take this really massive risk because I've vetted it, I have controls or I have good breaks to know that if this thing goes bad, I'm not going to blow everything up. And I just really think that because of SOX, because of the perceptions of whatever, because of all these things, and to be fair, this passive thing that we're talking about, that I'm talking about, like it is like audit is collateral damage to this. Like I think this is I know this is a very big, there's a lot going on here, and audit is a collateral piece of this. Um, but well, the message I tell the people that I talk to, and I tell my friends, I tell the people at Big Four who are younger, who are coming up, as I go, you need to focus on not just doing all the checklists and not just going through the motions. Like really learn about what's going on, because you can be a value add. Like I would go and talk to CAOs and CAEs right now and say, look, and boards, and I'd say, look, if you really want to grow top line and you're out of product ideas, there are definite ways to do this, but you got to understand what's going on underneath the surface. And there's no better group to help you do that than internal audit or risk manager or whatever. And so that's really what I'm basically saying, all right, the feeling you have, Mr. Mrs. Audit person, internal, external, whatever, risk, this feeling you have of, it's not, I don't, we're very, I don't want to call it like it's apathy. It's like, I just don't understand why nobody cares. It's like, well, because there's a lot of stuff going on here that is out of your control. And so to your question is like, okay, why do I care? It's like, well, or why do I care? What can I do about it? You should care because you should understand the game you're playing. You should understand this is what's going on. So when you go into that, like the CAE goes in the meeting with the CFO and says, I need heads, and you get that response, you go, okay, I understand what you're saying, but like, let's think about holistically. Like, you need to grow top line. Your product that we've been trying, you've had 4 different failures. Like there's other ways, right? That's number one. Number two is when you like, I feel really bad because I really do think that there is value add in this space. And I read the articles in Wall Street Journal about there's not enough, it's an accounting shortage, none of the kids want to do it, et cetera, et cetera. And I think this is really a message for the older people in the room. It's like, think about the future. Think about in 10 years when you want to hire a controller or you want to hire a director of internal audit or whatever, and all the people that are coming up now, we're talking about AI, like, well, who are you going to hire? Like, how's that going to work? Like, think about the downstream effects of what's going on and just be cognizant of that. So that's like, why do I care? I think I think this is a really good thing to understand for the health of audit, accounting, et cetera. And so the next question is like, okay, well, how do we fix this? How do we do, what can we do? The passive boat has sailed. Like the academics, the good thing is that like Mike has been on this for over a decade. The Cohens of the world, not Ryan Cohen of GameStop, but Eric Cohen of the activist investors are aware of this. The investment bank, everybody knows what's going on. This whole passive thing I'm talking about is not new. Unfortunately, I would suggest that maybe it exists for a reason. And I'll leave it at that. I'm not going to get making too conspiracy on you, but there is no, like, we've already passed the Rubicon. There is no turning back. So it's just, you got to understand what's going on and be aware of it. And really when you go have those conversations with the leadership, say, look, I understand the pressures you're under. I understand what's going on here. Help me help you. Like, let's be value. Like, how can we be value add? Like, here's what I can provide. Here's what my team can provide, et cetera, et cetera. Yeah. So I think that's the summary.
2 takeaways I have that are pretty common on the show. One being the organization needs to know the value that internal audit brings, because a lot of times they don't. And the other one is comes back to the thing we've heard over and over again. It's like, hey, internal audit, just know the business really well. Probably going to be okay.
And it's hard. I always like to play devil's advocate. It is really hard to be an internal auditor at a public company that wants you to be a SOX person. As a SOX person myself, because you're just inundated. Like, I feel so bad for not only the big four seniors and staff coming up doing, but like I tell people all the time, you need to get on private jobs because that's how you learn business. That's how you learn how the burrito is made. I use food analogies. And I feel really bad for internal audit teams at a lot of public companies because SOX is an audit problem. Let them deal with it. And then they become, all they're doing is SOX testing, and all they're doing is checklists, and all they're doing is trying to check off what other PCW comes up with this year. And this is another thing to point out too, for the last, we're in 26 right now. So from, like it or not, this isn't a political statement. Whenever you have political changes, the PCOB is a government entity. It just is. And so depending on which, it's like the Game of Thrones, like which king sits in the castle, you're going to have vastly different regulatory emphasis, right? I can say without a single hesitation that in November of 24, everything changed from the last 4 years. And it was stark. The pendulum swung extremely hard. And I don't know what's going to happen in the next, in 3 years, but what I can say is that unfortunately, I think the pendulum is going to swing a lot more. And so, like, for the internal audit folks and listening to this, because this is the internal audit podcast, I have talked to some really forward-thinking internal audit groups at certain companies. Like, there are certain companies that I know of for sure whose internal audit groups are value add, hands down, doing it right. And I unfortunately don't think that's the norm. And I think the more we talk about this and the more we make it, like, hey, by the way, there's probably, it's not just that audit sucks and they're the internal police. Like, that doesn't have to be the case. Matter of fact, I think that perception is something that we should try to eliminate. And so, like, I was talking to you about your episode with the Snowflake folks, and I think what they're doing is phenomenal. I mean, sorry, to segue into AI, I mean, we are in a period of, like I said, I'm a huge proponent of AI, Claude user. I just think that ever since the internet, nothing's changed in the accounting space for 20 plus years. You get the new SaaS products, you get new stuff, but like, it's all really the same. And this, is the opportunity that we've all been waiting for the last 2 decades. And it's going to accelerate faster than anybody can imagine. There's definitely going to be hiccups along the way. The adoption rate, people, I think it's McKinsey or somebody just had a study where it's like, of all of the things that have been implemented at companies of the last year, 90% of them failed. It's like, yeah, of course they did, because it's new.
Mm-hmm.
And this stuff changes so fast. I just wrote about it where January 25, I watched, speaking of browser, agents, I watched she sold her company. Her husband's the head of product at OpenAI, but her company at the time basically ran off of a browser agent it was OpenAI's operator, but it's just now been converted. And all it really did was it parsed the internet for product reviews and basically made Jira tickets and all these things. It was incredible. But I watched that and I go, oh, when I create a document for my team over in India, I create screenshots and I create instructions, and they have to go in and download and get all these things. And I go, oh, seems like that's no longer necessary anymore. We can prompt AI to do that, especially if it can literally take your cursor and move it around, do these things. So I just think for internal audit, the future is bright, but we have, I think the big takeaway from this for everybody, and I'll be at the head of this parade, is you got to have good breaks. I think that's brake hard to go fast. If you're a company, private or public, and you want to grow top line, and you want to go, increase your base, whatever, you got to have good brakes. You can go all gas, no brakes, and you'll get where you want to go, but eventually you're going to run into a wall. Unfortunately, I don't know when that happens. Otherwise, I'd be able to tell you more specifically, but I think investing in good brakes, investing in the risk component, I'm using risk as a broad general term, and understanding risk and having those people that know the business, that, get them off of the checklist. Like, AI is going to replace all of this monotonous stuff that nobody wants to do, and let people get back to learning about companies and learning how something operates. Like, my first client at Ernst & Young, I didn't even know existed. And they were the largest manufacturer of all these things that I use every day. And I got to go to these plants and I got to do inventory. And it was great. And I was like, oh my God, this is how America works. America doesn't run in the cloud. Like, people make things and it's great. And you get to learn all these things. But now the people that come up now are just like, okay, what's my checklist and what do I do? And how do I check this control and 20 samples? Oh, cool. And that's like, it could be so much more. And so, yeah, I think the future's bright.
Hey everyone, thank you very much for listening to this episode of the Audit Podcast. Whatever platform you're listening on right now, I'm sure there's a subscribe button somewhere, so please hit the subscribe button there. If you're listening through iTunes or Spotify, feel free to go give us that 5-star rating. It only took me about 16 seconds to give myself a 5-star review, and it really helps to get future guests to come on the show, so we'd really appreciate that. Lastly, be sure to check out the show notes and follow us on all our social media channels on Instagram, on LinkedIn, and on TikTok. Also, if interested, please sign up for our weekly newsletter from the Audit Podcast. Thank you all. Have a great one.